Hi guys, welcome to class 22. So we're going to be starting chapter 14. And up to this point, we've been focusing largely on income items. That is what's included in income and what's excluded. And with assignment of income, we were also talking about who is the proper taxpayer. Now, as we've seen with exclusions, the burden of proof is on the taxpayer to show that that exclusion is allowed. So too with deductions. Burden of proof is on the taxpayer to justify the deduction because, as the book states, deductions are a matter of legislative grace. A taxpayer has no constitutional right to a deduction. Therefore, service takes a very hard line, basically with any tax benefit, but especially with deductions. At the beginning of the term, I told you we'd be focusing on the individual taxpayer. But Section 162, which is the workhorse business expense deduction, allows deductions for business expenses, and it applies to both individuals and corporations alike. If the individual is doing business without being incorporated or has a pass-through entity like an LLC, then these deductions are taken against business income on a Schedule C that goes into the 1040. Section 162 provides there shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on a trade or business. Now, as you will see, there are a lot of gray areas in Section 162. Let's take a look at the seminal case of Welch versus Helvering on page 311. As an aside, remember Helvering versus Horst that we talked about in our last class on assignment of income. Well, you may think this guy Helvering is one litigious guy, but actually Guy T. Helvering was the IRS commissioner back then, and many cases were brought in his name. Now, Mr. Welch was the secretary of the Welch Company. This was a family-owned business that had been started by his father. The company went bankrupt and was discharged from its debts. Welch undertook to voluntarily pay some of those debts in order to reestablish his good name, as well as his credit. He then sought to deduct those payments as a business expense. The commissioner disallowed that deduction, saying that these were not ordinary and necessary business expenses, but instead they were in the nature of capital expenditures as an outlay for the development of reputation and goodwill. Now, this is something important that we'll be discussing throughout this chapter, and that is the distinction between currently deductible ordinary and necessary expenses and capital expenditures that are not currently deductible. Now, a capital expenditure is an expenditure to develop, create, or establish an asset. It relates to the underlying foundation of the business. That is, it's an investment in the business, rather than being an ordinary and necessary expense, which implies ongoing expenses to keep the business running on a day-to-day basis. So a capital expenditure increases the basis in that asset, while an ordinary necessary expense allows a current tax deduction, and so it's more of a current benefit, therefore bigger benefit. Now, both currently deductible expenses and capital expenses provide a tax benefit. The question is one of timing. With a currently deductible expense, you get a current benefit, that is an immediate benefit for that taxable year. While with a capital expenditure, the expense has to be added to the basis, and the benefit either is realized later on down the road when that asset is sold, or if it is amortizable, that is, can be written off, such as depreciation, then you take it over a period of time. Welch versus Helvering tackles the issue of what ordinary and necessary means. The Supreme Court says that necessary means appropriate and helpful. Another way to look at it is that the expense is profit-seeking in nature rather than personal in nature. The court struggles a bit more with the meaning of the term ordinary. It states that this is a variable affected by time and place and circumstance. It goes on to say that it does not mean that the payments must be habitual or normal, in the sense that the same taxpayer will have to make them often. It gives the example of a business defending itself against a lawsuit, which may only happen once in a lifetime. But defending against lawsuits is a common and accepted means of defense against attack. So basically, the term ordinary means a currently allowable expense rather than a capital expenditure. Going back to the facts of Welch, the court notes that people do sometimes voluntarily pay the debts of others, but this is not an ordinary thing. In fact, the court states it's highly extraordinary. The court struggles with a concise definition of the term ordinary, and at the top of page 313, it states, "The standard set up by the statute is not a rule of law, it's rather a way of life. Life in all its fullness must supply the answer to the riddle." Okay, here's a little test. Have you ever heard that before? Does that sound familiar to you at all? It was in footnote 9 in Duberstein, and we discussed it back when we were talking about gifts and the Duberstein case. Now, if Duberstein doesn't ring a bell either, then you really do need to go back and review. Right now, review a lot. On page 313, the court states that reputation and learning are akin to capital assets, like the goodwill of an old partnership. Now, make a note of that because we'll return to that later. One thing we can say here is that when the payment is a bit weird or out of the ordinary, the service is likely to put pressure on the taxpayer to show that the expense served a business need and is neither capital nor personal. Looking at the problems on page 314, we have taxpayer who's a businessman, local politician, and also an officer director of a savings and loan association of which he was a founder. When partly due to his mismanagement, the savings and loan began to go under, he voluntarily donated nearly $500,000 to help bail it out. Is that payment deductible under Section 162? Although arguably this amount was an indirect contribution to the capital of the savings and loan, nevertheless, in the Conti decision, the deduction was allowed as an ordinary necessary business expense to protect and preserve both the taxpayer's existing business activities and his earning capacity. The court saw the issue as a balancing process in drawing a line between expenditures to preserve and protect his business reputation, which are deductible as ordinary and necessary under 162, and those that will improve and develop goodwill, that is, a non-deductible personal expense under 262. Now, certainly the need for such a payment and directness to the taxpayer's trade or business are also relevant factors. An interesting case involved the country music star Conway Twitty, who was also known as Jenkins. That was his real name. And the case was Jenkins versus Commissioner at 48 Tax Court Memorandum 238. This was a 1984 decision. Now, Mr. Jenkins was allowed to deduct the payments made from his personal funds to reimburse investors in his failed Twitty Burger restaurant chain. Apparently, Conway was a better singer than he was a burger chef. The court allowed these deductions because they were made to protect the star's reputation and success in the country music industry. Some other somewhat similar cases and rulings allowing 162 deductions include the case of James O. Gould, G-O-U-L-D. found at 64 Tax Court 132. This was a 1975 decision. In this case, the employee of a creditor corporation, who was also the sole shareholder of the debtor corporation, allowed a 162 deduction on payment of the debtor's debt to the creditor because he made the payment to preserve his status as an employee of the creditor. Lutz, L-U-T-Z, versus Commissioner at 282 F. 2nd, 614, a Fifth Circuit decision from 1960, involved a dealer in agricultural produce who made deductible payoff of debts of his corporation's business in order to maintain his own credit rating and retain his license to deal in agricultural commodities, which he might have lost without the action taken. Revenue Ruling 76-203. In this case, a moving and storage company's partial restitution to uninsured customers for losses suffered when a fire destroyed the company's warehouses was made to preserve the company's goodwill and protect its business reputation, and therefore those expenses were deductible under 162. But see Orville versus C. Walker at 32 Tax Court Memorandum 690 from 1973, in which payments by a bank employee to a bankruptcy trustee were held non-deductible, even though he claimed the expenses were incurred to maintain present employment. In other ordinary necessary cases, the IRS has ruled that a corporate executive could deduct the cost of liability insurance to protect against liability arising from wrongful acts committed within the scope of his employment. This is Revenue Ruling 76-277. But a wood products broker was denied a 162 deduction for payments to an ordained minister who was hired to raise his employees' spiritual awareness level. A deduction was allowed for the portion of the minister's salary related to other miscellaneous business tasks. This case is Lionel Trebilcock, Trebilcock, at 64 Tax Court 852, 1975, and the service acquiesced in this at 1976-2, Cumulative Bulletin 3. The second problem, consultant incurred ordinary necessary business expenses on a business trip for which she was entitled to reimbursement from the client upon filing an expense report. However, the consultant did not file the expense report and was not reimbursed, but instead deducted her costs on her income tax return. Is consultant entitled to a 162 deduction? Well, the court in the Height case stated that since the employee was entitled to a reimbursement for the use of a personal car, and she voluntarily relinquished that deduction under a self-imposed rule adopted to avoid criticism from her subordinates, her failure to receive the reimbursement was based primarily on considerations of personal choice and convenience, and certainly not out of any necessity of office. Therefore, she got no deduction under 162. In the case of Harry M. Flowers at 61 Tax Court 140, a 1973 decision, the taxpayer here was an independent contractor. He was to be reimbursed for legitimate business expenses, but only at his retirement, death, etc. The expenses which he incurred were non-deductible in the year they were incurred because they were in the nature of loans or advances, which would subsequently be reimbursed under the agreement. So therefore, according to the tax court, no current deduction. Our second section here deals with expenses. Now, I am on page 314 again. When you incur an expense in your business, you must first determine whether it really is a business expense or whether it's more of a personal expense. So, for example, if you travel for business purposes and then you spend some time enjoying the sights, is that more of a business expense or a personal expense? A true business expense is currently deductible. Personal expense is not. However, if it is a business expense, you then must determine whether this is an incidental expense or whether it's a capital expense. A capital expense must be capitalized, that is, added to the basis, where it either stays until the asset's sold or otherwise disposed of, or it may be amortized, that is, written off over time like depreciation. So if you purchase a property, all the expenses in connection with that purchase or acquisition of that property must be capitalized. And these include commissions and transaction costs as well. If a taxpayer constructs a building, the costs of construction also must be capitalized. Now, that's not a big surprise. But if you have any equipment that you used in the construction of the building that would otherwise be depreciable, those depreciation deductions also must be capitalized under the Idaho Power Company case discussed on page 316. On the other hand, if you rented that equipment, then the amounts that you paid for the rent also must be capitalized. Also, any wages paid to construction workers must be capitalized, as must the tools and materials that were used in the construction. So in this way, those who build their own building are treated in parity with those who purchase a building. Now, another area in which capitalization issues arise is in determining whether an expenditure is a repair that's currently deductible or an improvement to the property that's required to be capitalized. The Midland Empire Packing Company case on page 318. The taxpayer there incurred a significant expense in lining the basement of his packing company in concrete to prevent oil seepage from a nearby refinery. The taxpayer used that basement to cure hams and bacon and to store meats and hides. The taxpayer claimed this expense as an ordinary necessary repair expense, but the service challenged it as a capital improvement that was not deductible, but instead had to increase the basis of the building. The tax court engages in a discussion of the difference between a currently deductible repair and a non-deductible improvement or replacement. It quotes Illinois Merchants Trust Company on page 318. To repair is to restore to a sound state or to mend, while a replacement connotes a substitution. A repair is an expenditure for the purpose of keeping the property in an ordinary efficient operating condition. It does not add to the value of the property, nor does it appreciably prolong its life. It merely keeps the property in an operating condition over its probable useful life for the uses for which it was acquired. Now, this quote is taken from the regs at section 1.162-4, which is in footnote 1 on page 318. A capital expenditure, on the other hand, is a replacement, alteration, improvement, or addition that prolongs the life of the property, increases its value, or makes it adaptable to a new or different use. The tax court in Midland Empire Packing found that the expenditure incurred by this taxpayer was a repair that served to keep the property in an operating condition over its probable useful life for the purpose for which it was acquired. Note that if this taxpayer had recently purchased this building to use for meat packing and storage, this same expense would be considered an alteration or improvement to the building that would not be deductible. So then it would be considered part of the acquisition cost and would have to be capitalized. The service then said, this is not an ordinary expense in this taxpayer's business. But the tax court quoted Welch versus Helvering to say that the IRS had said in that case, ordinary does not mean that the payments must be habitual or normal in the sense that the same taxpayer will have to make them often. They simply must be the common and accepted means of defense against attack. It's always great when the court quotes the service to itself. The tax court then said that protecting its building from oil seepage so that it could be used for the purpose that it had always been used would seem to be the normal thing for this taxpayer to do. Therefore, this was essentially a repair for which the taxpayer could take a current 162 deduction. Now, one thing I want to mention about this case, the expense here was great. It was a pretty substantial expense. That, no doubt, is what caught the attention of the service. The larger the expense, generally, the more likely it is that it's a capital expenditure, but not always. So even though it's a large expense, it does not necessarily mean that it's a capital expenditure, as we see in Midland Empire Packing. Now, if an expenditure improves the property, it must be capitalized. Now I'm looking at page 322. An improvement results in a betterment of the property. It restores the property or adapts it to a new or different use. A betterment ameliorates a material condition or defect in the property that either existed at acquisition or arose during production of the property, whether or not the taxpayer was aware of the condition or defect. Second, it results in a material addition to the property. And third, it is reasonably expected to result in a material increase in capacity, productivity, efficiency, strength, or quality of the property. The regs provide that the removal and replacement of the asbestos insulation in a building is not a material addition to the building and does not materially increase the capacity, productivity, efficiency, strength, or quality of the building. So that expense may be currently deductible. Now, amounts paid to acquire or create an intangible property. Now, here I'm on page 325, and the case of Intangible Inc. versus the Commissioner. Now, Intangible involved a friendly takeover of a company, National Starch and Chemical, by another company, Unilever. National Starch, the target company, that is the one being taken over, incurred certain professional expenses, such as investment banking, legal advice, and other expenses, that it sought to deduct on its final income tax return. Now, note that after this takeover, National Starch was a wholly owned subsidiary of Unilever, the acquiring company. National Starch also tried to deduct some miscellaneous expenses too, such as accounting, printing, proxy solicitation, and SEC fees in connection with the takeover. The service disallowed these deductions, stating that they were capital expenses, and the tax court agreed, as did the Third Circuit. So Intangible then went to the U.S. Supreme Court and lost, because the Supreme Court agreed with the tax court and the Third Circuit. National Starch had ordered that these expenses could not be capital expenses because they did not create or enhance a separate and distinct additional asset. Therefore, there was nothing really to capitalize. The Supreme Court said several interesting things here. First, toward the bottom of page 326. Where no specific asset or useful life can be ascertained, the expense may be deducted upon dissolution of the enterprise. Second, There's a presumption of capitalization. Deductions are exceptions to the norm of capitalization. I'm looking at page 327. Therefore, the court said, deductions must be strictly construed and allowed only as there is a clear provision therefor. Third, again on page 327, the court said in determining whether an expenditure is currently deductible or not must be decided on the facts and circumstances of each case. The distinction between these types of expenditures is one of degree, not of kind. Fourth, in this case, the expenditures produced benefits for National Starch/Indopco that extended beyond the year in which the expenditure was incurred. And that is an important test in distinguishing between a currently deductible expense and a capital expenditure. I'm looking at page 329. Another consideration, according to the court, was that these expenses changed the corporate structure for the benefit of future operations. These types of expenditures have long been recognized as capital expenditures. That's probably the most important factor here. Fifth, so National Starch's expenses have to be added to the basis of Indopco, the new corporation, as an acquisition expense, and may be taken when Indopco is dissolved, rather than allowed as a current expense deduction. Now, after Indopco, there was consternation among business taxpayers because many of the expenses that they had been deducting routinely also produced significant future benefits. So the service issued rulings in the wake of Indopco, allowing expenses such as advertising expenses, incidental repairs, and employer-incurred training costs of an ongoing business to be currently deductible. The regs generally require capitalization of amounts paid to acquire, create, or enhance an intangible asset. Second, amounts paid to facilitate an acquisition or creation of an intangible. And third, amounts paid to facilitate a restructuring or reorganization of a business entity or transaction involving the acquisition of capital, including a stock issuance, borrowing, or recapitalization. The regs also provide, though, that compensation paid to employees, overhead, and de minimis costs do not have to be capitalized as amounts that facilitate a transaction. Let's take a look at the problems on page 334. In problem 1, we have a landlord who incurs the following expenses during the current year on a 10-unit apartment complex. We're asked if each expenditure is a currently deductible repair expense or a capital expenditure. The first one is $500 for painting 3 rooms of one of the apartments. Now, this is generally going to be deductible under 162 as an ordinary necessary expense, except when it is done as part of or incident to a general reconditioning or overhaul project of that apartment or that complex. B, $4,000 for replacing the roof over one of the apartments. The roof had suffered termite damage. Well, this one's unclear. It has characteristics of both a deductible expense as a repair and a capital expenditure as a replacement. So that one could really go either way. C, $1,000 for patching the entire asphalt parking lot area. Well, this is a repair. It may relate to the entire parking lot, but it's a repair. So therefore, they're just patching the parking lot. That's currently deductible. D, $3,000 for adding a carport to an apartment. That's going to be a capital expenditure. It is an addition, a creation. It materially increases the value of that complex and that apartment. E, $100 for advertising for a tenant to occupy an empty apartment. That's a currently deductible expense. In 2, are the regulations on capitalization of amounts paid to acquire, create, or enhance intangible assets consistent with the Supreme Court's decision in Adopco? Well, these regs that I mentioned to you a minute ago seem to vary significantly from the standards announced by the Supreme Court in Adopco. Most importantly, they reverse the presumption that an expenditure must be capitalized by listing expenses for created intangibles that must be capitalized. According to the excerpt from the preamble to those proposed regs quoted in your casebook, the regs define the exclusive scope of the significant future benefits test for created intangibles, so that if an expenditure is not listed in the regs, it may be deducted, at least until there's future published guidance, and then only prospectively. Additionally, while the regs seem to defer to the significant future benefits test, the operation of the provisions does a great deal to undermine the test as the standard for determining whether an expenditure should be capitalized. On the other hand, it should be pointed out that the Supreme Court did not establish the substantial future benefits test as the touchstone for deciding all capitalization issues. In fact, the court simply states only that a taxpayer's realization of benefits beyond the year is undeniably important in determining whether the appropriate tax treatment is immediate deduction or capitalization. Thus, it could be argued that the court left quite a bit of wiggle room for the Treasury to design an administrative response to handle future capitalization questions. One of the Treasury's concerns in drafting these proposed regs was administration of the tax system. Sometimes it may be a trade-off between clearer, more easily administered rules that perhaps do not reach perfect results, and rules that may be more theoretically defensible, but that frequently lead to a case-by-case factual analysis. One other thing that may be going on here is that after the Adopco decision was announced, a large coalition of substantial corporations mounted a lobbying campaign to obtain relief from the substantial future benefits test. One theory is that the proposed regs are the success of that effort. In 3, suppose the taxpayer in Adopco had performed some of the services in connection with the takeover transaction itself, in-house. Would the regulations require those expenses to be capitalized? Compare that situation with a taxpayer who pays an employee in connection with the construction of a new building. Is the difference in the results justified? Well, if the taxpayer in Adopco had paid part of its expenses itself using in-house counsel, those expenses would have been deductible under the regulations because of the simplifying assumption that compensation to employees is not treated as facilitating a transaction. This rule eliminates the need for an employee to keep time records to substantiate that her employer may deduct all of her compensation. On the other hand, the excerpt from the Idaho Power Company case makes clear that employee expenses in connection with the construction of tangible property must be capitalized. So it's difficult to justify the distinction in approaches between tangible and intangible property. What the court probably is referring to is an ongoing employee, that is, not someone hired specifically to facilitate the transaction or who specifically facilitates the transaction. So therefore, if it's an employee that has been an employee for a while, was not hired specifically to facilitate the transaction, then that employee's expenses should be currently deductible under the regulations. Section 3 deals with carrying on a business and the case of Morton Frank versus Commissioner on page 334. Now, here the taxpayers wanted to purchase and operate a newspaper or radio station. So to that end, they traveled around the country investigating possibilities. They incurred some incidental expenses in doing that, such as travel, phone, telegraph, back in the days when they had telegraph, and some legal expenses. They finally purchased a newspaper in Canton, Ohio, and started operating that month. They then tried to deduct these expenses on their tax return that year, and the service denied those deductions. The taxpayers then contested this denial in the tax court. The tax court held in favor of the government, saying that under Section 162, in order to be able to deduct business expenses, you actually have to have a business. In the case of the Franks, they were looking for a business, not carrying on a business. Therefore, they could not take their deduction. So the Franks would have to eat those expenses. My apologies to you. I just noted that I have the wrong page number listed there. It's 334, not 234. Once the Franks located the newspaper they wanted to buy, then those costs, the transactional and acquisition expenses, would have to be capitalized, that is, added to the basis of their business. Note 3 on page 337 says the courts have held that the transactional stage is reached at the point where a preliminary investigation has led to the decision to purchase a specific business, but further investigation of the business continues. After Frank, Congress enacted Section 195 to ease some of the harshness of the Frank decision and to encourage the formation of new businesses to stimulate the economy. Under this provision, up to $5,000 of startup expenses may be deducted in the year the business begins operating, and any remaining expenses can be capitalized and amortized over a period of 180 months. This deduction is phased out for startup expenses between $50,000 and $55,000. Now, let's look at the various types of expenses that may be incurred in starting and operating a business. So first, you may have investigation expenses. Now, these are the incidental expenses along the lines of those the Franks incurred. Revenue Ruling 99-23 defines investigation expenses as expenditures incurred in the course of a general search for or investigation of a new business and which new business to enter. This includes an analysis and survey of markets, products, labor supply, transportation facilities, legal expenses, which includes due diligence, and investment banking expenses for research and evaluation of the potential business. These expenses fall under 195. So up to $5,000 of them may be taken in the year the business becomes operational, and the remainder must be capitalized and amortized over a 180-month period. Transaction costs are really part of acquisition costs, so they must be capitalized and added to the basis of the building. These costs include expenditures to investigate the purchase of a specific business. So here there may be an overlap with investigative expenses, except now you're only investigating a single business, so you've honed in more specifically on what you want to buy. These costs may include the evaluation of businesses and competitors after a decision is made to acquire the business. This may be done to establish the purchase price. It also includes appraisals, tax accounting advice, and drafting of regulatory approval documents. Then there are acquisition costs, the cost of purchasing the business. And of course, those must be capitalized. These include legal expenses, recording fees, accounting fees, etc. Then we have startup expenses, also called pre-opening costs. These fall under Section 195, and they include expenses incurred subsequent to the taxpayer's decision to purchase a particular business and prior to the time that business begins operating. In specific, these include advertising expenses, salaries and wages paid to employees being trained, travel expenses incurred in lining up potential distributors, suppliers, and customers, salaries to executives, consultants, and other professionals for similar services, and employees' salaries for stocking inventory, etc. As the text states, in order to fall under 195, the startup expenditures must be of the type that would be allowable as a 162 deduction if paid or incurred by an existing trade or business. So in order to use 195, first of all, the taxpayer must enter the trade or business. And secondly, the expenses must otherwise be ordinary and necessary expenses that would have been deductible under 162. So 195 provides relief for expenses that otherwise would not be deductible and would not be capitalizable either. After your business has opened, then all ordinary and necessary expenses will fall under Section 162. So that's it for this class. Again, if you have any questions, feel free to call or email, and I will share those with the class. For next time, I'd like you to take a look at the problems on page 342 and to read pages 343 through 374 and look at the problems at 356 to 357. So that's problems on 342, read 343 through 374, and work the problems on 356, 357. See you in the next class, and stay safe out there.